Welcome back to this video series about private equity net returns. These episodes are designed to help GPs build scalable and defensible track record models that satisfy the modernized SEC marketing rules that went into effect in November of 2022. After I released the first 4 videos, the SEC issued additional guidance related to the use of subscription lines of credit. So I wanted to provide an update and give you a few options for addressing these facilities in your models. First, let us revisit the problem. GPs typically present their gross returns in a table like this, where investments represent the capital flows between the fund and its portfolio company investments. These cash flows exclude management fees, fund expenses, and carried interest, but many other things like the use of a subscription line and also recycling, bridge financing, management fee offsets, assets and liabilities on a fund's balance sheet, and much more. Of course, it has always been important to show the net returns along with gross returns, and back in the old days, we could satisfy that by slapping a net return line here down at the bottom of the table that measures the capital flows between the fund and its limited partners. Here, the net multiple is 1.41 and the net IRR is 14%. Now, the SEC marketing rule really emphasizes the importance of always presenting gross and net returns together with equal prominence. And many fund formation lawyers and compliance consultants have interpreted that to say, look, if you're going to advertise the gross IRR of the realized and the unrealized investments, you better also present a net IRR with equal prominence. And some have gone even further to say that if you display gross returns for individual portfolio company investments, you should also display net returns with equal prominence as well. Now, the problem is that none of these net returns on the right are real. There's no such thing as a net return for a portfolio company because all the fees, expenses, and carried interest in the fund are pooled across all the investments. At best, we can generate theoretical model-driven estimates of net returns that depend on subjective decisions about the amount and the timing of various fund-level deductions. The SEC's own rules would define these as extracted returns and hypothetical returns, and this series explained 3 different options for calculating them. Video 102 describes the conventional net return model where you start with the gross cash flows and then layer on streams of fee, expense, and carry deductions. This is how most GPs do it, but there's a lot of subjectivity around the timing and the amount of the fund deductions, which makes the results volatile and the models difficult to scale. Video 103 introduces a better net return model that can be built about 10 times faster. The secret is that we systematize the deductions for fees, expenses, and carry, and this makes the model easier to build and scale. You get more return measurements with a lot less spreadsheet work. Finally, Video 104 introduces the effective net return model, which is even faster because you don't even need portfolio company cash flows, but the formulas are full of exponents and natural logarithms, so unless you're a real math nerd, you might have a hard time defending this one in an SEC examination. Overall, your best bet is the better net return model in Video 103, which I'll briefly summarize now. Here is an example of a set of gross portfolio cash flows that give us the gross multiples and the gross IRRs that we showed earlier. The total return column on the right is just the sum of all cash flows, and the realized and unrealized columns use sum-if formulas to pick out the realized and the unrealized deals. All the multiples and IRRs are driven by these core gross cash flows in the center. In the better net return model, we take all the negative cash flows, which are portfolio company investments, and we make them a bit more negative to account for each deal's pro rata share of the fund's expenses and management fees. And then we take all the positive cash flows, which are realizations and fair market values, and we make them a little less positive to account for each deal's pro rata share of carried interest. Now, when we total these adjusted portfolio cash flows, we get a new portfolio net multiple and net IRR that includes all the fees, expenses, and carry in the fund. We get similar net return metrics for the realized and the unrealized columns, and we also get net multiples and net IRRs for each of the portfolio company investments. By making the timing of fee, expense, and carry deductions coincide to existing gross inflows and outflows, we do 2 things. 1, it removes all subjective decision-making about when these deductions should occur, and 2, it forces the model to use the same math for every investment in the portfolio, which really simplifies the footnotes. That's all I'll say about the model for now. Go watch Video 103 if you want to learn more. It's under 13 minutes long, and the episode page includes several helpful Microsoft Excel templates. Okay, so now let's talk about these subscription lines of credit. In my experience, GPs mainly use these to smooth out their capital calls. They borrow capital to make 1 or 2 new investments, and then 6 or 12 months later, they pay off the line when they call capital from LPs. The result of this delay tends to make limited partner net IRRs a little bit higher, around 1 or 2%, and the net multiples or TVPIs a little bit lower due to the interest charges on the subline. Now, again, in my experience, none of the buyout growth or venture funds that I've worked with have ever used a subscription line to lower their cost basis and amplify their returns, like you might see with SBIC leverage or the way that debt amplifies equity gains in an LBO. When lines get paid off, that amplification doesn't happen. It's really a matter of convenience for the GP and LP. Private equity investments are complicated with a lot of moving parts that can change up until the day that a deal closes. If you pre-call capital from LPs and the deal doesn't close, then you must send that capital back to them. Sometimes a co-investor will back out at the last minute, and then that capital that you pre-called 15 days ago is no longer enough. Subscription lines of credit can help alleviate this, and they might allow a GP to only make 2 capital calls in a given year instead of 5 or 10 different capital calls and distributions. And that can result in significant time savings for the back office of both the GP and the LP. Anyway, back to the SEC, which issued the following FAQ in February of 2024. The question is, must gross and net performance shown in an advertisement always be calculated using the same methodology and over the same time period? And the answer is definitively yes. The implication is that if a GP represents gross returns as capital flows between the fund and its portfolio companies, which everybody does, and then presents net returns as capital flows between the limited partners and the fund, and that fund uses a credit line, then this presentation results in IRR calculations being made across different time periods. And such a presentation would violate the provisions requiring presentations of performance in a format designed to facilitate the comparison between net and gross performance. Wah, wah, wah. So what do we do? Well, the FAQ suggests that the remedy is to create a model that shows what the net returns would be if the fund did not use the subline, but instead calls capital from LPs simultaneous to the portfolio company investment gross cash flows. Now, does that sound familiar? This is exactly what we do in the better net return model that we described in video 103. This net IRR at the bottom right is a net IRR that uses the same methodology and same time period as the gross IRR calculation. And that consistency in methodology and time period goes all the way down. For example, here's the gross and net cash flows for the fund. Same methodology, same time period. Here are the gross and net cash flows for the 4 realized investments. Same methodology, same time period. And here are the gross and net cash flows for the first investment, AlphaCo. Same methodology, same time period. So the net IRRs calculated from the better net return model are very good options for satisfying this latest requirement from our friends at the SEC. But let's say that you're not convinced and you don't want to use that better net return model. Then allow me to suggest another option that I've explored with a couple of clients. This time we'll start with the net to LP fund capital calls and distributions and then adjust them for the use of the subline. Here's how I like to set up the fund level return calculations. It is best to always have 2 contribution columns, one with negative values for capital calls and one with positive values for the return of contributions. This lets us keep track of what's really happening with some of these cash flows. Like in March 2020, we have offsetting positive and negative contributions due to new investors coming in at a final closing and paying off the earlier investors with notional interest. And in 2021, when we had the fund returning a bit of capital because they called too much in the prior quarter. These little details will be appreciated by the future analyst who becomes responsible for this model about 5 years from now. The third column here includes the distributions. The fourth includes the fair market value after deducting carried interest, and the net cash flows on the right sum these 4 columns to provide the net IRR of 14%. This format also gives us net multiples. The DPI comes from distributions divided by net contributions, the RPI comes from fair market value divided by net contributions, and the TVPI, or net multiple of invested capital, is the sum of distributions in FMV divided by the net contributions. A quick side note here, many GPs are a little sloppy about distinguishing between returned contributions and distributions. They can usually get away with it because that distinction has no impact on the carry calculation, the preferred return calculation, or the net IRR calculation. However, improper classifications can cause errors in these net multiples down below because they can cause capital to be incorrectly attributed to a numerator when it should be in the denominator, or vice versa. Okay, so we remember from the gross return table that the first portfolio company investment was made in December of 2018. But here we don't call capital until June of 2019, so clearly we have some subline activity going on. One way to spot check or sanity check our expectations is to ask, what if we just moved all the contribution dates up 6 months earlier, but kept the distribution and fair market value dates the same? This wouldn't change any of our multiples, but it would reduce the net IRR to 11.7%, and that's kind of a limit for us. We shouldn't expect our subline adjustments to have much more of an impact than that. Now, the easiest way to accurately adjust these net to LP cash flows for the subscription line is to look up the outstanding subline balance for each of the dates on this table. And this reveals to us what's really happening with these capital flows. In December 2018, we borrowed $26 million for the first investment, as well as management fees and fund expenses. And then we pay it off when we make the second investment and call capital of $51 million in June of 2019. We borrow again to fund deals number 3 and 4 in December of 2019 and June of 2020, and then the big capital call in September pays off the line and reserves capital for deal number 5, which will close in December of 2020. In June of 2021, we call capital for the 6th investment without using the subline, but we borrow again to fund deals number 7 and 8 in December 2021 and June 2022, and then we pay off the subline with the last big capital call in December of 2022. So there's a lot going on here, but guess what? You do not need to know any of these details to calculate a subline adjusted net IRR. All you need to do is look at that subline balance and measure the change. If it goes up, that's a negative number, and if it goes down, that's a positive number. We can treat these changes just like contributions, and when we move this column over to the left, we get a new set of subline adjusted net to LP cash flows, which provide identical net multiples but a slightly lower net IRR of 12.17%. This is our subline adjusted net IRR, and it just so happens to be exactly the same as the 12.17% that we got from the better net return model earlier in this presentation. Now, here's a figure that I think helps to explain what's really happening under the hood of this model. The light blue line represents the cumulative actual capital calls from the LP. So there's basically 5 of them, which take the net contributions up to $205 million. This is the denominator of our net multiple and net IRR calculations. By including these subline changes as contributions, we replace that denominator with the darker dashed line, which has pulled several of the contributions forward so that they more closely match the investment activity of the fund. Note that we still end up at total net contributions of $205 million because at the end of the period, the subline balance is 0. So this is fundamentally a correction in the timing of cash flows, and one that I think should satisfy the SEC's concern about the consistency in methodology and time period. Okay, so that is solution number 2, and I think it's a good one. As always, consult with your fund formation lawyers and compliance consultants about what might be the best solution for your funds, especially on this next point, which might be a little controversial. Basically, the SEC is saying that even though we delivered a 14% net IRR to LPs, we can't show the 14% because it benefits from the use of a subline. But that subscription line also has a cost in the form of interest. Given the subline balances on the right, the interest might add up to about $4 million if the rate was around 5%. Now, I think it's reasonable to ask, if we're adjusting our model to remove the subline's benefit, shouldn't we also adjust it to remove the subline's cost and perhaps add back that interest as if it was a distribution? We can do that by moving these interest payments over to the left, providing a new set of subline and interest adjusted net to LP cash flows, which increase the DPI to 0.871, increase the TVPI to 1.429, and also increase the net IRR to 12.88%. So that is something to think about, but I do recommend that you consult with your legal and compliance teams about whether adding back that interest is the right thing for you. So just to go back and summarize these models, the fund's real actual net to LP returns are a 1.41 net multiple and a 14% net IRR. When we use the better net return model to synchronize all net and gross cash flows, we get the same net multiples and a subline adjusted net IRR of 12.17%. The benefit of this approach is that not only do we adjust the entire fund's net IRR, but we also get a subline adjusted net return for every investment in the portfolio. When we use the subline balance to adjust the net to LP cash flows, we get the same net multiple and another subline adjusted net IRR measurement of 12.17%. A benefit of this approach is that it's a little more intuitive, and the only extra data you need is the subline balance, which you could probably pull off a bank statement. The downside, of course, is that you don't get those subline adjusted net IRRs for individual investments like you do with the better net return model. When we use this approach, but also add the subline interest back into the model, we get a higher net multiple of 1.43 and a slightly improved subline adjusted net IRR of 12.88%. The obvious advantage here is that the returns are better, but who knows if you'll actually get away with this. Now, you might be thinking, hey, this is a heck of a lot of work for a 1.5% difference in net IRR, and on that point, I agree with you, but given the SEC's guidance from February of 2024, I think that these are the easiest and most accurate ways to solve the problem. Thank you for watching. Make sure to go to the episode page at Auxilia Mathematica, where I provide all the data in this video, as well as a Microsoft Excel template that you can use as a starting point for your own models. Also, if you need more help in getting your net return models up to speed, feel free to get in touch with me by phone, email, or through my consulting website. Thank you for watching, and see you next time.